Alright guys, welcome to another week ahead video. Now our focus in this week will turn back to sterling as well as the ongoing Brexit saga. Now right now it's really the final countdown for the Brexit saga with less than 7 weeks to go before the end of the official transition period, which is of course the last day of December. So how far have Brexit negotiations really progressed in the last couple of months, especially with this looming countdown in mind? Well, not very far, unfortunately. Taking a look at this very handy illustration from ING Investment Bank, which covers most of the major three contentious issues, which is of course state aid, fishing, as well as equivalence for financial services. Looking at that, we can see that all three of these are still a thorn in the flesh for the current negotiations, with no clear imminent breakthroughs right now in sight. So how has the market really been taking the threat of this looming deadline and the no clear sign of progress? Well, not bad at all. Actually, if we take a look at the pound's performance over the last couple of weeks and months, it shows that the markets are still leaning towards the chance and the probability, or higher probability at least, of a deal scenario. And according to ING Investment Bank, the market hasn't really priced in any real risk premium for a no-deal outcome versus the almost 5% risk premium that was built in during the 2019 withdrawal agreement negotiations. Now, taking a look at this chart above from Zenith, we can see that the 1 month and 3 month implied volatility for sterling has decreased after that September spike to the upside. And we can also see similarly that upside protection has continued to grow more and more as participants are betting on a further rise in the pound, as evident by that massive rise we've seen in the 1 month and the 3 month risk reversals. Now that begs the question on whether the market might be getting ahead of itself and whether there's too much complacency right now in terms of how the market is pricing for this final countdown. Now, looking at the week ahead, right now we are in that final 7 weeks of the Brexit saga, which doesn't mean that from 1 January 2021 everything will just be forgotten. Of course, it simply means that the overall countdown towards the end of the transition period has officially reached crunch time. Now, above is a very, very handy timetable, a Brexit timetable compiled by the team at Bloomberg in a recent article. And we can see that these last 2 weeks in November is arguably the most likely and, let's say, best chance for a deal to be reached. And the reason for that is because both sides do need time to actually get approval for a deal, get a deal ratified, cross the T's, dot the I's, so to speak. However, the market has been through all of this rigmarole before, like we said, going back to 2019 with that withdrawal agreement negotiations. We only saw a deal really being clinched during crunch time. And we have also to remember that usually whenever the EU is involved in any type of negotiations, the EU Recovery Fund was a good example. We always see those negotiations that involved with the EU always goes down to the wire, and we always see them at 99.99% reaching a deal at the very, very last minute. Now, in the past 2 weeks, the UK government's basically lost very avid Leave campaigners in the form of Dominic Cummings as well as Lee Kane. And even though that should mean that there's arguably a better chance for a compromise from the UK side, there is still, of course, PM Johnson to deal with, and he is said to be one of the hardest in the room on Brexit and the least willing to budge, according to a recent article in The Guardian over the weekend. So what does all of this mean for Brexit? Well, nothing really, to be honest, until something concrete transpires. Right now, both a deal as well as a no-deal outcome is still very, very possible. And even though most investment banks are currently siding towards a 60-40 deal, a probability for a deal versus a no-deal, as long as the two sides are continuing to talk, the possibility of a deal is actually higher than that. If we take history as an example. So as time runs out towards the end of this month, we will either see some compromises from both sides or either side, and that could swiftly lead to a deal, especially once again if we look towards the example of 2019's withdrawal agreement. But alternatively, either side can get tired of waiting and tired of postponing everything, tired of waiting for the other side to concede, and might call an official end on negotiations, which can, of course, open up a lot of pain for the pound without any real risk premium built in. So it is important to keep in mind, though, that a deal is theoretically still possible at any time, whether it's before or after the transition period ends. So, we might see both sides playing hardball, going through the transition, seeing that it opens up a whole can of worms for both sides, and then in January or February, return to the table and then start negotiations. So either side can try walking away from negotiations as a very daring bluff to try and force a compromise, and that will of course see a massive move to the downside in the pound. But then we might also at the same time, after a couple of days or a couple of weeks, we might see, a proposed compromise bringing both sides back to the table. And that can see an entire reversal, of course, of that move again. So the bottom line right now is, I think, waiting for concrete developments, whether it's positive or negative, really seems like the best and most prudent approach to take with trading the British pound right now. So taking a look at possible sentiment shifts and a trade plan. So scenario 1 is looking for concrete breakthroughs on the contentious issues. Now in this scenario, we are looking for concrete breakthroughs on any of the 3 major contentious topics, whether that is fisheries, state aid, or financial equivalence. Take note that the recent positive comments, we've had a few about fisheries, we've had a few about state aid, all of those positive comments has really had very short-lived and small reactions in the pound, a knee-jerk to the upside and then it fades to the background. And that shows that the markets right now are waiting for more concrete developments. And that means we do need to be careful of not reading too much into positive developments as it hits the wires, unless it is massive breakthroughs that is confirmed by the big guns like PM Johnson or Ursula von der Leyen, or from one of the 2 key negotiators, which is of course Michel Barnier and David Frost. Now the trade plan in this scenario would be to expect upside for the pound across the board, and secondly upside for the FTSE 100 equity index as well. Do take note that during the 2019 withdrawal agreement, the pound absolutely went one way after the very first breakthrough was announced, and the market started to price in the possibility of a deal being reached. Now, if we compare what we are seeing right now to what we had in 2019, like we said, in 2019, we had a major big net short position on the pound and a massive risk premium built into the pound as well. And that exacerbated the upside that we saw in sterling, because short positions started to unwind as the move to the upside gained more momentum. Now, that means that the upside this time round might be a little bit more limited for the pound, especially if the market looks towards the more medium-term implications of what leaving the EU actually means for both economies. And that can actually see some, like a knee-jerk reaction to the upside in the pound and then a complete reversal of that move. So we do want to be very, very careful of how the pound reacts if and when we do see any concrete breakthroughs hitting the wires. Now, scenario 2 sees either side officially ending and walking away from trade talks. Now, we do want to be careful, like the previous example, or like the previous scenario as well. We don't want to be reading too much into comments without knowing where the source is coming from. So if it's somebody like, again, PM Johnson or Ursula von der Leyen or Michel Barnier or Frost coming out saying that they are officially ending and walking away from talks, those are going to be the type of players that we want to be focused on for these types of comments. And remember, according to ING, like we said, back in 2019, there was about a 5% risk premium built into the pound. And right now there is none. So if we do see a massive blunder with either side officially walking away from talks, that's arguably going to see a much bigger reaction in the pound compared to a positive reaction, especially if we take a look at implied volatility and risk reversals. The markets really are priced towards a deal right now and not a no-deal outcome, and that can really see an exacerbated move to the downside if trade talks completely collapse. Now, in this example, the trade plan, we would expect to see outsized and exacerbated downside for the pound across the board. Also downside expected for something like the FTSE 100. The one thing that we do want to be careful of here for the FTSE, for example, is that, because of if we do see such a massive move lower in the pound, that can actually be a positive input for the FTSE, because about 71% of the revenues of companies in the index actually generate those revenues, 71% of them outside the UK, which is normally dollar denominated. So if we do see a massive move lower in the pound dollar, for example, that can actually lead to upside for the FTSE 100 on the back of just the exchange rate move itself. So do keep that in mind as a potential caveat for the FTSE 100 if we do see massive downside in the pound from either side officially walking away from trade talks.